Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to talk about goodwill. Okay, the effect of goodwill, how to give the effects of goodwill in the partner's capital account, right? Now, before we discuss about the treatment or the effect of goodwill, let us just recapitulate the term goodwill what we have studied earlier, right? Now, as we all know, what is goodwill? Goodwill is something that the name, that the reputation that the firm has earned over a period of years, okay, and for that the firm is earning profit. Okay, now when the firm is incurring losses, the term goodwill doesn't arise. Okay, or if the firm is having a or average profit, the normal rate of return, then also the term goodwill doesn't arise. When goodwill arises, when the firm is getting certain benefits, okay, certain extraordinary profits the firm is earning, then the term goodwill arises. Okay, now goodwill, like we discussed earlier, there are two types, right? One is purchased goodwill and one is self generated goodwill. Now when I say purchased goodwill means what? Purchased goodwill is when one firm takes over another firm, right? When one firm takes over another firm, the firm which is taking over another firm, they are paying goodwill. Okay, when they are paying the purchase consideration, that purchase consideration includes the amount of goodwill that is known as a purchased goodwill. Okay, and that goodwill actually appears in the books, right? Self-generated goodwill is something what the firm tries to evaluate its value in the market. Okay, that is a self-generated goodwill, and they are not supposed to show that goodwill amount in the books. Okay, now when we talk about the self-generated goodwill arises when there is a reconstitution of a partnership firm, in that if there is a retirement or a death or there is an admission of a partner, right? Why so? Because there is somebody who is entering into the business, or else there is somebody who is exiting from the business. Okay, now when somebody enters into the business, what that person is going to get? When we talked about the admission of a partner, when a new partner enters into the business, that partner is going to get the future benefit, future profits. Okay, why future profits? For that, what the existing partners had done, they have maintained that market reputation. Okay, for because of which the new partner is going to get the benefit. So when a new partner enters into the business, he has to bring a premium of goodwill. Okay, his share of goodwill he has to bring into the business. Why so? Because the existing partners, earlier, let's say there were existing partners, two partners A and B, they were sharing the profits equally, but now they involved C into the firm. Okay, C also enters the firm, so they are sacrificing this part and this part of profit so that C gets this profit. Okay, so they are sacrificing their future profits. Now for that, C has to give the premium of goodwill. Similarly, when we talk about the retirement or death of a partner, right? When we talk about retirement or death of a partner, this is a profit which was being shared between three partners, A, B, and C. I'm saying taking the same situation. Okay, A, B, and C, and all the three partners put on the efforts and created a market value, market reputation. Okay, and because of which the three of them are getting the benefits. Now C is retiring from the firm. So the future profit for which C also put on the efforts are going to be gained by whom? A and B. Okay, A and B, this particular rate of returns and this particular returns will be gained by A and B in their gaining ratio. So what happens over here? Here C is retiring from the business, so A and B has to give the premium of goodwill. Till that point, whatever is the goodwill amount, whatever is the C's share, will be given to C by whom? By the remaining old partners, that is A and B. Or if the C dies, then to their legal representatives, A and B are going to share the premium of goodwill in their gaining ratio, right? Now we talked about the methods of goodwill. Okay, average profit method, wherein they calculate the profit of the past 5 years. We took the examples of past 5 years, how much profit every year the firm is in earning, and based on that they take out the average of profit of the 5 years and what they expect that this profit we are going to receive the same amount or same kind they expect that they will receive for the remaining, for the next 2 years or 3 years or 5 years. Okay, that's how they determine the value of goodwill in case of simple average profit method, right? And then they take out the share of, like, how much share the new partner is supposed to bring into the business when we were talking about the admission of a partner. Same will be the situation when they are taking out the valuation of goodwill. Same situation, they will take out the share of goodwill which A and B needs to give to C. Okay, then we talked about the weighted average profit method, wherein the weight was to be given to which year? To the current year. Okay, similarly weight was being assigned. If 3 years profit is being given, then the more weight was being given to the current year's profit. Okay, the last year's profit. Okay, similarly we talked about the super profit. Mind it, goodwill, when I say, when it comes into the picture, when the firm is earning profit over and above what the firm, what the other firms get, right? If somebody is investing an amount in the market, if somebody is, let's say, investing 100 rupees and they are getting 8 or 9 rupees average profit, in average return they are getting, but there is a firm who is earning a profit, and in that firm if somebody invests, they are going to get 12 or 13% rate of return, that is 12 or 13 rupees from that. So this is the over and above. Okay, the normal, this is the normal rate of return, this is the over and above the rate of return, that if somebody invests in that particular firm, they are getting this much rate of return. So then comes the super profit. When it comes to super profit means over and above this also, maybe 15% or 20%, that is the super profit. So similarly they calculate the average profit and they determine the super profit based on that, whatever the profit that is the market is giving, right? And they take out the average profit of their firm, and then they determine how much super profit they are incurring. Okay, how much super profit they are earning as compared to the market, as compared to the normal rate of return, and then they determine how much this amount of profit they are going to receive in future for how many years, right? And then we discussed about the capitalization method, wherein we capitalized the average profit or the super profit, right? The same thing when we are doing in case of retirement or death of a partner, the same way we are calculating the value of goodwill. Okay, here how we will give the effect in case of an admission. What we did, these two partners are sacrificing. Okay, so the new partner which is entering into the firm, that new partner has to bring the premium of goodwill. So this partner C will bring the premium of goodwill, which will be shared among A and B in their sacrificing ratio. They will receive the premium of goodwill in their sacrificing ratio. In this case, who is, there is nobody to sacrifice. Okay, C is going to sacrifice, A and B will gain. In the future they are going to gain C's share. Okay, so they have to give goodwill to whom? They are supposed to give goodwill to C. Okay, in what ratio? In their gaining ratio, in their gaining ratio. So try to understand, whosoever is gaining has to give to the partner whosoever is sacrificing. Here C is sacrificing, here C is existing from the business, so A and B have to give the premium of goodwill to see in what ratio, whatever ratio they are going to gain in future from C's share. So gaining ratio, they are going to give the goodwill amount to C. Let's say there are three partners, 1:1:1. Simple example, and the goodwill amount is 30,000. So C's share will be how much? 10,000. Okay, this 10,000 A and B are going to gain in the same ratio, that is 1:1, right? So this 10,000 will be given by whom? A and B. Okay, their capital amount is going to reduce. What will be the journal entry? A's capital account debit 5,000, B's capital account debit 5,000 to C's capital account. C is going to get this premium of goodwill from A and B in their gaining ratio, and that is 10,000. Now you know how to calculate the gaining ratio. If at all gaining ratio is not given, what you will be given? The new profit sharing ratio, and you will be given old profit sharing ratio. When you deduct old profit sharing ratio, gaining ratio, when you deduct old profit sharing ratio from the new profit sharing ratio, you are going to get the gaining ratio. Either this will be given, or else you will be given the gaining ratio, right? So this is how we are going to give the treatment to the goodwill. Okay, now this week what we talked about the self generated goodwill. What if there is a goodwill which is already mentioned in the books? Okay, goodwill already mentioned in the books, that means it is a purchased goodwill. Before we talk about the self-generated goodwill, we need to give effect to this goodwill which is already mentioned in the books. Okay, this is the purchased goodwill which is being shown in the books. Okay, so what we are supposed to do? We are supposed to close that goodwill account, and that goodwill will be shared among whom? To the old partners which were already existing in the business when the goodwill was already there. Just you need to keep in mind the things which were already there before the reconstitution of a firm. Before the firm reconstitute, whatever was there in the books will be shared among the old partners in their old profit sharing ratio. The sacrificing ratio, the gaining ratio, the new profit sharing ratio comes when anything changes. Okay, when there is a reconstitution of the firm, so anything changes, then the new profit sharing ratio and sacrificing and gaining ratio is going to come. But before that, everything whatever is there in the books, if they need to close the accumulated losses, if they have to make any kind of a revaluation of their assets and liabilities, whatever it will be shared between the old partners, among the old partners in their old profit sharing ratio. Similarly, this goodwill which is already mentioned in the books will be shared among A, B and C in their old profit sharing ratio. Okay, let's say old profit sharing ratio was 3:2:1. Okay, and the value of goodwill already in the books was 1,20,000. Okay, this is 1,20,000. So 1,20,000 divided by 3, 4, 5, 6 into 3, 1, 6, 2, 6, 12, 2, 3. So 60,000. Then 3 for B 40,000, and for C 20,000. We will write off this goodwill amount from their capital account, and we will close the goodwill account. To goodwill account 1,20,000. This goodwill account, first we need to close it. Okay, and this goodwill account will be balanced from whom? From A, B and C's capital account, from the old partners capital account, right? And then we will give effect to the self generated goodwill. This is self generated goodwill. to whom we will give effect. First we need to close this old goodwill account, and then we need to identify the goodwill of the firm, and then we will give effect of this self-generated goodwill amount. Okay, so this is how we are going to give the treatment of goodwill. The same way we discussed about the admission, in the same way everything is going to be the same in case of a retirement or death of a partner, wherein they determine the value of goodwill. What is goodwill? As we already discussed, determine the value of goodwill based on the three methods, and then give the effect of the goodwill amount. Okay, and there is one more term which is hidden goodwill. Okay, now I need to first discuss, before we discuss about this, there is one thing in your books which I forgot to discuss. Let's say, okay, there are three partners, A, B and C. Okay, now A, B and C. C, as we discussed, is going to retire. Okay, he retires from the firm. Okay, now A, B and C were sharing profit and loss in the ratio of 1:1:1, right? That means 1/3 A used to get, 1/3 B used to get, and C used to get 1/3 of the profit. Now let's say C retires and B says, I am not going to be the active partner of this firm. Okay, in the future what they decided, that I will get that they decided the new profit sharing ratio as 3:1. That is, B is going to receive how much? 1/4. Okay, 1/4 of the profit B will receive. So C is going to receive how much? This much. Okay, this much of the not this much, in fact this much. This is the profit which A is going to receive, that is 3/4. Okay, so A is going to get share of what? A is going to get share of C. Okay, C's share, as well as A is going to get share of B. This whole A is going to get. Okay, this case what happened? B is also sacrificing his share of profit. Okay, earlier B used to get 1/3, but now B wants only 1/4 share in profit. So B is also sacrificing his share of profit. Okay, now if he is sacrificing his share of profit, who is going to gain? A is going to gain. Okay, C's share as well as B's some share. So in this situation, what will happen? In this situation, A is going to give the premium of goodwill amount to C as well as to B. Okay, C, let's say this was the goodwill amount 30,000. It was C's share was 10,000. Okay, and B's share is 10,000. The three share is 10,000, 10,000, 10,000, right? Now we will determine the gaining ratio, how much A is going to gain. How we will determine A's gaining ratio? New ratio minus old ratio. What is the new ratio? 3/4 minus old ratio 1/3. That is how much? 4 3s are 12, 3 3s are 9, minus 4, that is 5/12. This is the gaining ratio of A, and B, and new ratio minus old ratio. New ratio is 1/4 minus 1/3. 4 3 12, 3 minus 4, that is minus 1/12. Minus 1/12, if we say is a gaining ratio, that is sacrificing ratio is 1/12. So this is B's sacrificing ratio. So B is going to sacrifice 1/12. Who is going to gain? A is going to gain. So everything, whatever A is gaining, will be shared by A. The premium of goodwill amount will be given by A to B as well as C. Let's say it was 30,000. So A's capital account debit. So how much B is sacrificing? It is 10,000 into 1/12. So 1/12 are 8 1200, 4 36, 3 12 36, 4 36, 3 3. Okay, so B's goodwill amount is 833. So how much A is going to give the premium of goodwill to B and C? To B's capital account, to B he will give 833, and to C's capital account, to C it is going to give 10,000. So it is 10,833. This is the situation when only one partner is gaining, okay, and both the partners are sacrificing, right? So there could be this situation also. Now let's talk about the hidden goodwill. We talked about hidden goodwill in case of admission and retirement, or admission of a partner. In the case of a retirement or death of a partner, how we will know that they have given the goodwill to the partners? Let's say, I don't have space, let's say C's total capital, the amount due to C was how much? Let's say 1 lakh. Okay, this 1 lakh includes what? This 1 lakhs include capital amount plus interest on capital amount, whatever interest till that time he retires, or till the time it was a unforeseen situation wherein he dies, so they have to give interest on its capital amount, plus and deduct any drawings, interest on drawings, okay, interest on drawings, then the goodwill which was already there, less the accumulated losses, okay, accumulated losses, add any accumulated profit, and as well as we give the effect of revaluation gain or loss. After giving the effect of all these things, we determine that the amount due to C is 1 lakh rupees, okay. But how much they give to C? They give to C 1,20,000 rupees, okay. The amount due was 1 lakh, they give 1,20,000, so 120 minus 1 lakh is 20,000. This 20,000 is the hidden goodwill. They give this amount as a premium of goodwill to C. So this 20,000 will be given by A and B from their capital in their gaining ratio. The journal entry will be the same. A's capital account debit to B's capital account to C's capital account. Okay, this was the concept of hidden goodwill. I hope you got it. It's a kind of a revision for you, right? You already practiced this thing in admission. The same is there in case of a retirement or a death. Admission, new partner enters into the business, so he has to bring the premium of goodwill in case of retirement or death. An existing partner is retiring or he dies, so the already old partners who are going to get the benefits in the future for the profits, they are going to give this premium of goodwill to the partner who is retiring or who has passed away. This is it. I hope you got it. Practice about it. We are going to discuss more about this. Again, there will be the revaluation, all these things, accumulated losses and profit. We are going to revise as such about all these things. So see you in the next video. Till then, thank you very much.